Imagine you've got this huge stack of dense reports, articles, and you need the key insights fast, right? Without getting totally bogged down in jargon. Well, that's exactly what we do here on the Deep Dive. Our mission is simple. Cut through all that noise, pull out the most important nuggets of knowledge, maybe some surprising facts, so you can get up to speed, like, instantly. Today, we're taking a deep dive into Hims & Hers Health, Inc. We're focusing on their second quarter 2025 earnings and also the big strategic moves they've laid out in their latest financial reports. So our goal here is to give you a really clear, engaging overview, where the company stands financially, their, frankly, ambitious plans for going global, and also the big challenges they're actively tackling. We want you to quickly grasp what's most important in their journey right now. Okay, let's unpack this. Hims & Hers is clearly in a period of pretty significant growth, and their Q2 numbers, well, they really show that energy. Get this, in Q2 alone, they hit over $544 million in revenue. That's a massive 73% increase compared to last year.
Yeah, 73%. And it gets better. If you look at the first half of 2025, the full 6 months, they've already blown past $1.13 billion. That's a 90% jump year over year. 90.
Wow. And what really stands out here, and this is key for you to understand, is that almost all of this revenue, like, what is it, 98%?
Pretty much, yeah. $536.88 million of that Q2 revenue was online revenue. So direct sales from their websites, their apps, mostly subscriptions.
Right. So this isn't just growth. It's proof their direct-to-consumer digital model is working, wouldn't you say?
Absolutely. It's validation. But while that online part is booming, there's this interesting little counter trend happening.
Oh, yeah? What's that?
Their wholesale revenue, the non-prescription stuff they sell to retailers, that actually dropped by 10% in Q2.
Dropped?
Oh.
Huh. Is that bad?
Not necessarily a stumble, no. It looks more like a strategic choice. The company basically said their brand awareness in physical stores is mature. Like, they've kind of hit the limit there. So they seem to be intentionally pulling back from lower margin wholesale.
To double down on the high margin online subscriptions. Makes sense.
Exactly. Optimizing profit, even if it means that part of the top line shrinks a bit. It's a calculated move.
Okay, so beyond just the big revenue numbers, what about profitability? Efficiency? Are they making money, not just growing?
They are, and that's where it gets really compelling. Net income, actual profit, jumped to over $42.5 million in Q2.
$42.5 million compared to last year.
Yeah, it's a 220% increase from Q2 2024, a huge surge.
220%. So yeah, they're not just growing fast, they're getting much better at turning that growth into actual profit.
Precisely. And their adjusted EBITDA, another key profit metric, that also saw a strong rise. It hit $82.2 million in Q2.
Up from what, around $39 million last year?
That's right. So their adjusted EBITDA margin went from 12% up to 15%, getting more profitable per dollar of revenue.
Okay, but didn't their gross profit margin dip slightly? I thought I saw that.
You did. That's a fascinating layer here. While the total gross profit dollars surged, like you said, by 62% to over $416 million, their gross margin percentage did dip a bit, from 81% down to 76%.
So why would that happen if revenue and net income are up so much?
Well, it points to a few things. Probably a changing mix of products and services they're selling. Maybe some have lower margins than others. Could also be higher vendor costs for certain things, or, and this is key, increased fulfillment costs as they use their own pharmacies more.
Right, bringing fulfillment in-house.
Yeah.
That has upfront costs.
Exactly. They expect it to stabilize as they scale up, so it seems like a short-term efficiency trade-off for, longer-term control and maybe better margins down the line.
Okay, and what about managing their spending? Operating expenses?
They seem to be tightening the belt there, relatively speaking. Overall, JAP operating expenses as a percentage of revenue actually went down.
Down how much?
From 78% of revenue in Q2 last year to 71% this Q2. That shows increasing efficiency overall.
And here's where it gets really interesting for me. They talked about significant marketing leverage. Marketing costs went down as a share of revenue.
Yeah, significantly, from 46% down to 40% of revenue.
But wait, didn't they spend more on marketing, digital, social media? They even had a Super Bowl ad.
They did increase the dollar amount spent, yes. But because revenue grew even faster, the percentage dropped.
So they're getting more bang for their marketing buck, better customer acquisition.
That's what it suggests, yeah. Either their ads are working better, maybe brand recognition is higher now, or perhaps their customer retention or referral engine is just getting more efficient. It's a really positive sign for sustainable growth.
Okay. And other expenses, operations, tech?
Operations and support also got more efficient, down slightly from 13 to 12% of revenue. Tech and development saw a small increase from 6 to 7%.
Which you'd expect, right, for a tech-focused company constantly building things.
Absolutely. Got to invest in the platform.
All right, let's talk cash. They seem to have a lot of it now.
They do, a lot. Cash and cash equivalents grew significantly, hitting $1.1 billion by the end of June 2025.
$1.1 billion. Where did all that come from?
Okay, so if we connect this to the bigger picture, most of that jump came from a really strategic financing move back in May. They issued $1 billion worth of these things called 0% convertible senior notes.
0%. So free money. How does that work?
Well, not exactly free. It's clever. Investors lend them the money interest-free, basically. But
Right.
those investors get the option later to convert that debt into his and her stock if the share price goes up enough.
Ah, okay. So the company gets cash now without interest payments, betting that its stock will rise, making it attractive for lenders to convert later.
You got it. It's a common tool for growth companies. But here's an important point for you to note.
Okay.
While their cash from operations was positive, almost $90 million in the first half of the year, their free cash flow was actually negative $19.4 million for that same period.
Negative. So they spent more than they brought in, even after that big financing.
Not quite. Free cash flow looks at cash from operations minus capital expenditures, money they invest back into the business. So that negative number isn't necessarily a red flag here. It shows they're aggressively reinvesting.
Reinvesting in what?
Building out their own pharmacies, improving their tech platform, buying property and equipment, intangible assets, things crucial for their long-term plan.
Gotcha. Building the foundation.
Exactly. And you also see a big jump in inventory, up over $77 million. They're stocking up to meet demand, especially, it seems, for their GLP-1 weight loss offerings.
Okay, so we've just pulled back the curtain on this really impressive financial engine Hames and Hers has built. Strong growth, improving profitability, lots of cash. But great numbers are only half the story, right? Now let's explore where they're actually aiming all that power, their growth playbook, expanding their reach, their offerings, especially globally.
Right. And at the very core of that playbook is personalized care delivered through subscriptions.
That seems to be their identity.
It is. It gives them that reliable, recurring revenue stream we talked about, but it's more than that. It lets them build relationships, tailor solutions, really tackle health issues in a personalized way.
And are customers buying into that personalization?
Seems so. They reported that more than half of their subscribers, as of June 30th, are using personalized solutions now. So that shift is definitely happening.
And a huge part of their future growth seems pinned on going international.
Oh, absolutely. They explicitly called it one of the most compelling growth opportunities. Their earlier success in the UK seems to have really fueled that belief.
And they made a big move recently, right? The Xavi acquisition.
Yes, Xavi Global, acquired in July. And this is fascinating. It's not just buying revenue, it's buying infrastructure. Xavier gives them the platform and presence to serve Germany, France, and Ireland, plus expanding in the UK. We're talking a combined adult population there of roughly 160 million people.
Wow. That's a massive potential market.
Right.
What are they expecting from Xavier short term?
They project it'll add at least $50 million in revenue just in the rest of 2025, and importantly, with a positive adjusted EBITDA margin. So profitable growth from day one, basically.
And long term, what's the ambition internationally?
Huge. They're talking about serving tens of millions of users internationally and eventually generating over $1 billion in annual revenue just from outside the U.S.
$1 billion internationally. That's ambitious. Where are they starting next?
Canada looks like the first brand new market launch for their platform. They're planning to start there in 2026, initially with generic semaglutide for weight loss.
Targeting the weight loss market there specifically.
Seems like it. They noted that 2/3 of Canadian adults are overweight or living with obesity, so it's a significant market need. And beyond Canada, they're eyeing other European countries, Latin America, even Asia down the road.
Okay, besides geography, they're also investing heavily in their supply chain and specialty areas.
Yes, making really strategic moves there. They bought manufacturing assets from a company called CS Bio back in February.
Why do that?
It's all about control and capability, bolstering their supply chain, bringing more production in-house, likely for peptides and other specialized ingredients. They're also expanding their own network of pharmacies, their own lab testing facility, even their own peptide manufacturing site. The goal seems to be fulfilling the majority of customer orders internally.
More vertical integration. And what about new types of health areas?
Weight loss is clearly a huge focus right now. Expanding into new health and wellness specialties is key. Though it's worth noting, they mentioned weight loss might introduce some seasonality, a bigger bump in Q1 with New Year's resolutions.
Makes sense. And the whole semaglutide thing, is that still an issue?
Well, the FDA did resolve the general shortage of the brand name drug. However, Hims& Hers focuses partly on compounded versions. Their ability to provide compounded semaglutide specifically is still somewhat constrained by supply and regulations, but they are still offering access to certain compounded GLP-1s where it's allowed under specific statutory exemptions. It's a complex area.
Okay, so we've covered the impressive growth, the big strategic plays, international weight loss, owning the supply chain, but rapid expansion, especially in a field like healthcare, it rarely comes without, significant challenges, hurdles.
That's putting it mildly.
So what are some of the biggest regulatory hurdles or operational risks Hims& Hers really needs to navigate carefully here?
That's maybe the most critical question for their long-term success. Healthcare is just incredibly complex and regulated. Hims& Hers operates right at the intersection of telehealth, pharmacy operations, drug compounding, plus these newer areas like peptide development and lab services.
So many different rule books.
Exactly. It means constantly navigating this shifting landscape of laws, state laws, federal laws, and now international laws, too. Compliance is expensive, and the penalties for getting it wrong can be severe. And a lot of these regulations are, frankly, open to interpretation, which adds another layer of risk.
Does the fact they take payment directly from customers, not insurance, help?
It does, for now. It exempts them from a whole set of laws related to insurance billing and reimbursement. But if they ever change that model, or if governments impose broader controls on telehealth payments, their compliance burden could increase dramatically.
And the international push adds even more complexity.
Oh, absolutely. Every country has different rules for telehealth, for advertising prescription drugs, for compounding pharmacies, and especially for data privacy, think GDPR in Europe. It's a minefield.
Okay, beyond the pure regulations, what about just market acceptance? Competition.
Also critical. Their whole digital health model is still relatively new, right? The market's evolving super fast and it's getting crowded. It's intensely competitive.
They constantly need to convince people.
Pretty much. Success really hinges on educating potential customers, explaining why their platform is different, easy to use, beneficial. And they also have to address any perceived risks people might have about telehealth or about compounded meds or even about using AI in healthcare, which they do.
And new competitors could just pop up anytime.
Or new technologies that could confuse the market or maybe worse for them, start driving down prices across the board.
Right. And operationally, it sounds like they rely on a lot of different pieces fitting together perfectly.
They really do. Their whole model depends heavily on their affiliated medical groups, these networks of doctors, nurse practitioners, PAs who actually provide the care.
What's the risk there?
Attracting and retaining enough qualified providers is crucial. Plus, there's always the background risk that regulators might try to reclassify these providers as employees instead of contractors.
Which would cost a lot more in benefits and taxes.
Significantly more, yeah. Then there's the supply chain. They mention concentrating on a single supplier for some of their GLP-1 offerings.
So if that supplier has issues,
it could directly impact their ability to fill customer orders for those popular weight loss drugs. That's a big dependency.
And they rely on outside companies too, right? Tech stuff.
Absolutely. They lean heavily on third parties for essential services. Think Amazon Web Services for their cloud infrastructure, payment processors to handle transactions, shipping companies like FedEx or UPS. Any disruption with those key partners, an outage, a policy change, anything, could ripple through their operations very quickly. It highlights how even nimble digital companies have these critical external dependencies.
Now, switching gears slightly, but still under risks, it's important for you to be aware the company is also dealing with some legal challenges right now.
Yes, that's definitely part of the landscape.
They're facing two big securities class action lawsuits filed recently, June 2025. Shareholders are basically claiming the company made misleading statements, particularly about its relationship with Novo Nordisk, the maker of Ozempic and Wegovy.
Right, those suits allege misrepresentations. And following those,
two shareholder derivative lawsuits popped up in July. These target the company's directors and executives, making similar claims, but framing them as breaches of duty to the company itself.
So, legal pressure from multiple angles. What's the company saying?
They state in the report that they don't currently believe a loss on these specific lawsuits is probable, but they are happening.
Okay. Anything else on the legal front?
There's also an ongoing non-public investigation by the FTC, the Federal Trade Commission. It started back in October 2023. Again, the company says they don't expect it to have a material impact, but it's there.
And just inherent to the business, there's always the risk of product liability claims, right? Given they deal with medications and health services.
Exactly. That's always a background risk in this sector.
And finally, thinking about capital and just the demands of being a public company.
Right. They just raised $1 billion, but growth costs money.
It does. They actually state they anticipate needing more funds down the line to keep growing, develop new products, maybe make more acquisitions like Zavia.
So future funding rounds might be necessary.
Could be. And just operating as a public company itself is demanding. There are significant costs, regulatory filings, legal compliance, financial reporting. It all takes time, resources, and management attention.
And there's that stock structure thing.
Yeah, the dual-class common stock structure. It's important because it concentrates a large chunk of the voting power with the CEO, Andrew Dudum. This effectively gives him significant control over the company's strategic direction, which can be seen as both a positive for decisive leadership or a risk, depending on your perspective.
Okay, so we've covered a lot of ground here. We've navigated Hims and Hers' really impressive financial performance, especially that strong Q2 in 2025. We've seen their big strategic push into international markets, new specialties like weight loss, taking more control of their supply chain. And we've also examined the pretty complex web of regulatory, legal, and operational challenges they have to manage every single day.
It's a dynamic picture for sure.
Definitely. So hopefully this deep dive gives you a much more comprehensive look, something beyond just the headlines. A valuable, informed perspective on this rapidly evolving player in the digital health space. Now, as Hims and Hers sets its sights on serving tens of millions globally, expanding this personalized care model, here's something to think about. How will that fundamental tension, the clash between their desire for rapid, tech-driven innovation and the inherently slow, complex, and heavily regulated nature of global healthcare markets, how will that tension ultimately shape their big ambition to become a billion-dollar international player?